Excellent. And
Ron, John, can I add to that as well?
Sure.
I certainly agree with everything Tim said. There is, in every industry, as it gains in popularity, the industry finds a way to make itself not a niche product, but something that everybody can access. And everything that Eve talked about and that Tim talked about comes back to now taking an industry that was behind a veil, it was only for accredited investors, and making it more accessible to the broader marketplace. And they're doing it in different ways, and not just to do a pitch to myself, but we're doing it as well. As I said in our introduction, we have a daily liquidity prospectus mutual fund where we're trying to do the same thing, align the client's interest with our interests. So in our case, it's annual performance fees, not quarterly, hurdle rates to earn your performance fees, daily liquidity, daily valuation. In Tim's case, it's separating the alpha and beta, again, making it accessible to the broader market. In Eve's case, it's aligning the interests by having a netting and a fund-to-funds approach by, I don't know if this is right, Eve, it's almost like a co-op of CTAs that have created their own fund.
That's right. Yeah. We co-insure each other's performance.
Right.
In some way.
And that's very valuable because the client is not paying each manager for their performance. They're paying for the performance of the portfolio, and they're taking the risk of each other's performance.
So there's a lot of innovation going on, which is obviously very, very good because this is a space that should be accessed by not just the QEP, but obviously always, having to stay completely on side from a regulatory perspective. We are, again, I want to shift gears now a little bit and go towards, get Jay's thoughts on the current capital market environment. There's so much going on with the sovereign debt and with the central banks and the Fed. And Jay is at a very, unique position in terms of over 30 years of experience trading fixed income. He's lectured at the University of Chicago. He's, follows the Fed very closely. Really, I think it's a treat to get some of his astute insights.
Thanks, Ron John. Today is, I don't know if it's exactly Pearl Harbor, where it will, live forever in infamy. But when it comes to, global banking, today today was a change in the world, much as we saw in 2008 when we saw the brokerage industry, the investment banking industry change probably forever. Today, the United States, in my opinion, and the Fed became the lender of last resort to the world. Today, which I'm not necessarily happy about. Today was sort of a financial Marshall Plan, if you will. If you recall, in the early part of the 20th century, the United States didn't get involved in wars. They tried to sort of stick to their own shores, and then we had the Marshall Plan where we started to get involved everywhere. And that's happening now in finance, so that we are guaranteeing, as of today, every bank balance sheet basically in the world. And so the question then has, what is the net result of that? If you see today, for example, in the markets, and you're seeing your stocks are obviously buoyed by that because there's going to be liquidity to lend. You're seeing swap spreads, the spreads between private credit and perceived government credit narrow dramatically, as they should, because the credit that you're taking from bank to bank, if this is going to become the precedent, is now one credit. It will be made good. There will be money to lend. That's what's happened here. I don't necessarily think that's a good thing. I'll give you a good example, and then I'll give you a bad example. Again, I came into the business in 1980, but I was very interested in the business while I was in graduate school at Chicago in the late 70s. At that point in time, there was the silver crisis. Is any of you around long enough or have read about the silver crisis? That was the only time when an exchange nearly did not meet its obligations. In other words, the silver market blow-up that was generated by the Hunts created such a panic in the marketplace that for a short amount of time, it was perceived that traders on the exchange were not going to be made whole for their trades.
That's not the Montreal Exchange.
That's not the Montreal Exchange. Thanks, Ron John. And the whole clearing corporation concept. Now, if a clearing corporation, which is what we have with exchanges, is that the exchange guarantees every trade, that there is an exchange capital base, which in this case, the exchange capital base that had been set aside was exceeded. So what happened? There was a meeting of all the members of the Chicago Mercantile Exchange, which were the largest and most powerful banks in the world. And those banks made a commitment to back the exchange and therefore made good on the silver debacle, and hence there's never been a question of that integrity of a trade on an exchange since, because the capital of the members backed the capital of the exchange. It wasn't just a clearing corp, it was the individual capital. Well, here we have a situation where it appears, and this is the positive take on it, that we have now a clearing corporation for the world, and that the transactions of every individual sovereign nation or state will be backed by the transactions of the whole. Therefore, one can assume to be made good on all of those transactions. That's sort of the analogy that I draw from this historically. The question, however, is that what a market is? Is that what risk is? Is that, in fact, what capitalism is? Is that what business is? Is that what banking is? I mean, that's the question. We now have this clearing. Now, on an exchange, you're buying and selling, you're making trades. No one if a trader makes a bad decision, the trade is honored, but the trader fails and therefore busts and is gone, the trader's gone. It's efficiency. It's capitalism. It is, the law of the land. Some win, some lose. That's the way life is. In this case, however, you've not just backed transactions, you've encouraged bad transactions, and you are funding the traders that are losing. And you are allowing them all to participate. That is not good. And so, in the short run, celebrate. Stocks are great. The dollar's weaker. Commodities are better. Whew, boy, we really dodged that bullet. The problem is that behind the single bullet, there will be a machine gun barrage of bullets that will come at an accelerating pace in the weeks, months, years to come. This is a slow, painful grind, which ultimately will be some other catastrophe, which we will try to muddle through. So I'm not happy about this. I think it ruins, the credibility and the intent of financial markets. And I'm very concerned that instead of working toward a real growth of global economics, we're in fact leading toward sort of a mundane muddling of average performance in which we all win, but in the end, we sort of all lose.
No, excellent. And what I purposely want to do now is I did not introduce one more panelist, an aggregate panelist in the audience, because we definitely want to make this very interactive. We have a panel of experts, so if we could open it up to questions, I think that'll be most effective, because then we'll be answering the questions that are and the issues that are most on your mind.
The CTA chance. Let her go.
Yes.
Well, I can just touch on
Well, maybe, yeah, sorry. So I'll just repeat the question so that, because it's being taped and so forth. So the question asked by the distinguished member in the audience was, is with trend following systems, are you always in the market, either long or short, in terms of the exposure and so forth? So maybe we'll have Tim speak to this and then Denny speak to this as well after Tim.
So the first comment I would make is don't paint all CTAs with the same brush. We all do very different things. Okay, so that's the first comment. Second thing is, for our programs, they're all very unique. So in my alpha program, I could be long, short, flat on any particular commodity or future that I trade. In my broad commodity index strategy, I'm long or flat. Okay, so it's a ride it up if it's going up, go to cash if it's trending the other way. In my managed futures index strategy, it's long or short, no flat. We also run an energy-focused CTA where we're just focused on the energy markets, and there again, long, short, or flat as an alpha program. So it just depends on the program and what you're trying to accomplish.
Denny?
In our program, we cover over 85 different markets, but at any one time we won't have more than 35 positions. So that's just a way of managing the risk on a portfolio level. Now, so we can be long, we can be short, and we can be flat in any one time. What will dictate that is obviously the trendiness of any one market. We actually trade the 85 markets in 8 different sectors, so we do more of a sector play. So right now, at any one moment, we could be flat in one sector, long in one, and short in the other.
Oh, excellent. And I think just to add a little bit of color commentary is that the risk management systems come very much into play. So it's a good question with regards to systematic trend following. And obviously, there's a tremendous amount of diversity in systematic trend following. But if, depending on certain signals, depending on the processes, the risk, some of the risk exposure may be taken off the table and so forth. So that's why you could really get a diverse set of permutations and combinations. And while we definitely, and this is my fault in perhaps not doing a proper enough introduction, while there are, these 5 panelists have, some of them have trend following programs, then there's sector specialists such as the Auspice Energy program, the fixed income program that Jay runs. So Eve is running more than one program and so forth. So there's, we wanted, the panelists have been very nice. I didn't want it to be in any ways an infomercial, so we didn't go too much into that. We wanted to make it very educational, but I do encourage all of you offline to ask these members about their different programs in more detail.
You mentioned a point that I think we failed to address.
Yes.
You just said risk management.
Yes.
That is something that we take for granted because we do it every day, but I think we can all talk to it. I mean, one of the most interesting features of managed futures is that if you look at the drawdowns and the downside volatility of managed futures returns of pretty much anyone at this table, what you're going to find is that there's a great consistency in how we manage that downside. We don't tend to have the types of drawdowns that an asset class like the S&P will have, because we don't accept market risk. We manage our portfolios to a constant risk profile. And I don't know if anyone wants to talk about it at length, but I think, as I said, we've taken it for granted because we've been forced to do it for many years. And market risk is something that people don't understand. If you're a long-only equity investor, and I think Brockhouse had made this example a while back, if you look at the stock market at a 15% vol and the stock market at a 30% vol, while doubling the volatility of the market doesn't just double your chance of a 30% drawdown, it increases by a factor of 8. You have to manage the riskiness of your portfolio through stop-loss methodologies, as we all do, but also by how you assemble those things into a portfolio. How do you look at the volatility and correlations of the instruments you trade and put them together? And without going into detail, what I will say is if you look at the industry of managed futures, you will find that the drawdown control and the downside